Welcome to Talking Markets with Franklin Templeton. I'm your host, John Przygocki from the Franklin Templeton Global Marketing Organization. As a forward-thinking asset manager, Franklin Templeton leverages cutting-edge strategies and deep industry insights to unlock opportunities to help grow wealth. We're your trusted partner for what's ahead. We're here today in the studio with ClearBridge Investments Head of Economic and Market Strategy, Jeff Schulze. ClearBridge is a specialist investment manager of Franklin Templeton, and Jeff is the architect of the Anatomy of a Recession program, a program designed to provide you with a thoughtful perspective on the state of the U.S. economy. Jeff, welcome to the show.
Thanks for having me, John.
Jeff, let's start today's conversation, as we typically do, with a view of the economic landscape here in the United States and the ClearBridge Recession Risk Dashboard. We had a positive indicator upgrade last month with ISM manufacturing PMI new orders moving from yellow to green. Did any of that positive momentum carry forward through February?
Well, unfortunately, we did not have any other indicator upgrades in February. So the overall dashboard stands as it did back at the end of January. But I think more importantly, we did start to get a little bit more data on housing permits and retail sales. Those two indicators, we're still waiting for full catch up following the shutdown of the U.S. government in the fourth quarter of last year. But ultimately, when you take a look at this dashboard, this is really good news for the economy, where you have one yellow, one red, and the rest are green, which signals that the economy should be firing on all cylinders here in 2026.
All right, Jeff. Military action in the Middle East escalated between the United States, Israel, and Iran. We'll get to the impact on the capital markets in a few minutes, but what I want to focus on first is the impact on the economy. Do you anticipate any change on the ClearBridge Recession Risk Dashboard as a result of this conflict?
Well, we did nudge higher our odds of a recession from 20% to 25% because of the conflict. But when you look at all the individual indicators, really the one that I think will be impacted and will likely deteriorate in the coming months is our commodity indicator. Generally speaking, higher oil prices is a bad thing for the U.S. economy. And when you look at other indicators, you may see some movement on the yield curve or credit spreads, but at the higher level, some modest increase of the odds of a recession right now. But ultimately, we don't think that this is going to impact the economy in a real meaningful way, especially if the current conflict is limited to the time frame that's being discussed right now of maybe 4 to 5 weeks.
Okay, but if oil prices go up and stay up, won't that hurt the U.S. consumer and the economy overall, considering consumer spending is, I believe, approximately 70% of GDP?
Well, Goldman Sachs estimates that every $10 increase of a barrel of oil, if sustained, will shave around 10 basis points off of 2026 GDP. So there is going to be some impact. And, oil really is the most direct transmission mechanism from the current conflict to the global economy. But the good news, at least from a U.S. perspective, is that relative to history, the U.S. is a net producer of energy products, no longer a net consumer. So when you think about higher oil, it's kind of a mixed picture. Yes, you're going to have a drag on consumption because it's going to lower real disposable income, but you're going to have some of that partially offset by the benefits of increased job creation and profits for the energy sector. Now, the shift from the U.S. of being a net consumer to a net producer of oil is not the only key difference relative to history. Americans today allocate a meaningfully smaller share of their wallets to energy goods and services today versus pretty much any point in history, except for the 1 to 2 years following the pandemic. And the reason for this is that you've had decades of efficiency gains on things like miles per gallon when you drive your car from point A to point B, but also you've had a lot of growth of the overall wallet size.
All right, Jeff, let's transition to financial markets. How concerning is this development in the Middle East for financial markets?
Well, history shows that investors should take advantage of any opportunities that happen if you do see a sell-off, because the S&P 500 generally has solid returns following geopolitical dips. So when you go all the way back to the 1950s and you start with the Korean War, there's been over 20 geopolitical events that we can look at. And following the start of that event, on a forward 1 month basis, the S&P 500 is up 1.4% on average. Over the next 3 months, the S&P 500 is up 2.8%, so double that 1 month return. And over the next 6 months following that event, the markets are up 5.9% on average. So usually it's a buy the dip type of situation. But when you dig into the numbers a little bit deeper, the poorer returns following larger conflicts that metastasize into wars, it's really kind of a mixed bag. What's the most important consideration is that the broader economic conditions in the US, they tend to supersede geopolitical risk for the markets. So in some of the worst periods following military escalations were those periods that coincided with US recessions in 1973, 1979, and 1990. So the key takeaway here, with the dashboard being strongly green at the moment, we think recession odds are pretty low at the moment, even if you do see a sustained spike in energy, which is why we think the market will likely follow that usual pattern of buying the geopolitical dip, and the markets will ultimately grind higher as we look forward on a 3 to 6 month basis.
So, Jeff, that's some great historical context, especially given, as you stated, the U.S. economic backdrop being as strong as it is. Why are non-U.S. markets selling off more aggressively?
Well, it really comes down to one thing, which is oil, and the sensitivity and exposure to natural gas and oil. The U.S. is a net exporter of oil and energy. Areas like Europe and emerging markets, that's a very different scenario. And one of the key things here is the shutdown of the Strait of Hormuz. There's a lot of oil that moves through there. About 33% of global oil moves through that chokehold. You have about 15% of refined product seaborne trade that goes through that waterway, and about 20% of global liquid natural gas flows. And when you think about the fact that Europe is really exposed to natural gas, and Qatar is the world's second largest liquid natural gas exporter that has no alternative routes but to go through that strait, there could be a lot of disruptions, and there's going to be large increases on the price of oil and natural gas as a consequence, which is really going to hurt a lot of these regions overseas. Furthermore, you've seen the dollar gather some strength over the last couple of trading sessions because that is a risk-off currency, which tends to be kryptonite to emerging markets. So if this is a relatively short disruption, I think that you're going to see a pretty strong rebound in the non-U.S. markets. But if this is more sustained, I think we are going to see some more volatility, because that could potentially weigh on the growth prospects of those regions.
So, Jeff, taking a look at some of the other asset classes, the U.S. dollar strengthened, U.S. Treasury yields moved higher, Fed fund futures are removing cuts from the expectations for the remainder of 2026. How do you reconcile those moves?
Yeah, investors have responded to developments in the Middle East by, as you mentioned, bidding up the U.S. dollar. And I said this a second ago, but that's more of a kind of a safe haven trade, if you will. But what was unique is that U.S. Treasuries sold off. Yields went higher, and 10-year Treasuries are up about 10 basis points since the end of February, and they're back above 4%. And usually you don't see that together. You don't see a stronger dollar, yields move higher on the 10-year Treasury. And I think this combination reflects the risk of higher inflation from this pickup of energy prices. Now, Fed fund futures have now taken out about a half a rate cut from 2026 expectations, because, with the higher inflationary environment, that does reduce the urgency of the Fed to potentially create a more support for the U.S. economy. So when you're looking at this move, I think the U.S. dollar strengthened because there's less rate cuts potentially coming into the economy this year. So that's a more favorable interest rate differential from the U.S. versus the rest of the world. but also you've seen higher yields because of that higher inflation risk, and investors wanted some additional compensation because of that.
So how problematic is this for inflation?
Well, if you have a persistent spike in oil prices, materially higher than where we're currently at, you do have the risk of stagflation. And there's really three uncertainties at this moment. How long will the Strait of Hormuz be closed for? Will energy infrastructure in some of the surrounding countries be destroyed by Iran? So any energy infrastructure in Saudi Arabia, the UAE, Kuwait. And then lastly, does Iranian oil still continue to stay online? So we don't really know how it's going to affect inflation, but a rule of thumb for inflation is that if you have a sustained increase of 10% on oil prices, that will boost core CPI by about 5 basis points. It'll boost headline CPI, which includes both food and energy, by closer to 30 basis points. So it should pick up inflation this year, but I think the key takeaway is that when you look at inflation's trend coming into this situation, there was a lot of reasons to suggest that inflation was going to continue to moderate in 2026. So I like to look at core CPI. That's what the Fed looks at. It's a better measure of where trend inflation is going. And core CPI is really broken down into three components. You have goods inflation, so that's buying a car or furniture or toys or something of that nature. You have shelter inflation, and then you also have services ex shelter, better known as supercore. So that's like, what you would pay for a haircut, for example, or going out to dinner. Now, when you look at those three components, there were some encouraging trends. Shelter inflation has been moderating over the last couple of years, and that's a really big difference versus the inflationary spike that we saw in 2022. And that's the largest calculation that you have in core CPI. Goods prices have been pretty much flatlined. And with tariffs being reduced recently because of the Supreme Court decision, I don't really see a lot of inflation strength coming from that area. And although Supercore did have a pretty strong print in January, which is the latest release that we got, it has a strong relationship with wage growth, and wage growth has continued to moderate, which suggests that that tick higher is probably something more temporary rather than something more structural. So yes, inflation is going to pick up, especially a headline inflation. But when you look at the underlying trend of inflation coming into this, even if we do get a little bit of a boost here, we're expecting continued moderation as we move through the back half of this year.
How about the Fed's path forward for 2026?
Higher inflation may spook the Fed from continuing to ease in the back half of this year, but I think that these fears are probably a little overblown. Let's remember that the FOMC will likely view this pickup of inflation as supply driven. Now, when you think about tariffs or this pickup of inflation from oil price spikes or some of the supply chain disruptions that we saw back in 2021 and 2022 because of the pandemic, monetary policy can't influence that. Monetary policy can influence demand-driven inflation, make rates higher so people consume less. So I don't think that this is really going to deviate the path of where the Fed is going to go moving forward. And I think market pricing right now is probably pretty accurate. Markets are pricing close to 1.9 rate cuts this year. I think that that's probably pretty close to what my expectation is. I think we get one cut probably closer to September and another cut. I don't know if it's going to be December or January, but we're going to get another cut close to the end of the year. And ultimately, I think that's going to be positive for the economy and financial markets. But we're pushing out our expectations for that first cut because of this dislocation.
Okay, Jeff, let's transition a bit here. I know we talked earlier about markets from a geopolitical point of view, but prior to the military conflict, the artificial intelligence doom trade was front and center on investors' minds. What are your thoughts on the AI disruption that is being priced in?
Well, it was a bit like whack-a-mole as you moved through February. Different industry groups were getting hit because there was a perception that AI was going to make them obsolete. Started off with software, and then it moved over to different areas like travel, logistics, office real estate, credit cards, consulting, data, brokerage, wealth. I mean, there was a lot of industries that were hit. And, I understand the thought process. There are going to be industries that are going to be displaced. It happens with every major technological breakthrough. It creates enormous value for those new companies and it destroys old business models. But I think that we need to realize that it's going to create opportunities for active managers because a lot of these companies have really strong moats and they're going to adjust their businesses. They're going to use AI tools and they're going to extract even greater value from this new technology. And some of these stronger moat companies are being thrown out with those shallower moat companies that will be disrupted. So, we think that this is a great environment for active managers that understand the fundamentals of these businesses and how this technology ultimately will change what these businesses will be doing going forward. And I'll use software as a quick example. When you think about enterprise software, it's very deeply embedded into corporations. High switching costs. A lot of these companies have multi-year contracts, so that disintermediation is not going to happen over the next couple of years. But more likely, though, AI will allow these software companies to be more productive. And when you think about software's fundamentals, software is one of the strongest growing areas from a revenue and earnings standpoint, and they have really strong earnings revisions. So ultimately, I think there are going to be disruptions, but at the end of the day, this is going to create opportunities for active managers that can sidestep some of those companies that ultimately will be disintermediated.
Couple more here. Your call for a market rotation from the leaders, the mega cap tech firms, into some of the laggards like small, mid, and value has been occurring over the past 3 to 4 months. Can that continue?
Well, you've seen a little bit of a reversal of some of these trends. I mentioned before, non-US has been underperforming the US since the military strikes. Value has outperforming growth, so that trend is still intact. And small and large caps are roughly in line over the last couple of days. But I think there's more room to run with this trade. And it all comes back to earnings delivery. For a long time, the Mag 7 and mega cap tech were the only games in town when it came to earnings growth. And if you look to expectations for this year, earnings growth is much more democratized. A lot of these struggling areas are coming out of their earnings recessions, and given the valuation discrepancies between mega cap tech and some of these bigger AI-focused companies and small caps and value and the average stock in the S&P 500, even the non-US space, investors will flock to those cheaper sources of earnings growth. So although value has outperformed growth this year by about 10%, small caps have outperformed large caps by about 6%. The non-US space has outperformed the US by, depending on what you're talking about, 7 to 10%. I still think that there's more room to run with this broadening theme that we've been talking about for quite a long time, and it has been happening. And I think those fundamentals are still in place for that rotation to continue.
All right, Jeff, let's close today's conversation with a final thought for our listeners.
You've seen oil price spikes before throughout history. And a lot of times there's some conditions that need to be met in order to have a more sustained risk-off move in the markets, right? Usually the oil price spikes of 50 to 100% that have been sustained over a quarter or two, that is what will create a big dislocation in the S&P 500. Another thing that's important is where you are in the economic cycle. If you're late cycle and your economy is already slowing as this event happens, that usually causes a recession and a large sell-off. You saw it in the 1990 Gulf War. You saw it in 1973. And with the dashboard being largely green and pretty strongly green compared to those periods, I don't see that being a big risk. And then the last thing is that if you have a big move of oil prices and inflation is going to spike, what do central banks do? Do they turn hawkish? Do they start to raise rates to fight inflation? Or do they not? And looking at Fed fund futures, yes, a half a rate cut has come out of the market over the last couple of days, but participants are still expecting 2 rate cuts this year overall. So with the U.S. being a lot more insulated to large price spikes of energy because it is now a net exporter rather than importer, I would be a buyer of dips, just like we've seen historically throughout geopolitical shocks.
Jeff, thank you for joining me today in the studio. To all of our listeners, thank you for spending your valuable time with us for today's March update. If you'd like to hear more Talking Markets with Franklin Templeton, Please visit our archive of previous episodes and subscribe on Apple Podcasts, Google Podcasts, Spotify, or with any other major podcast provider.
As mentioned in the podcast, the Magnificent Seven are Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. This material reflects the analysis and opinions of the speakers as of March 4th, 2026, and may differ from the opinions of portfolio managers, investment teams, or platforms of Franklin Templeton. It is intended to be of general interest only and should not be construed as individual investment advice or a recommendation or solicitation to buy, sell, or hold any security or to adopt any investment strategy. It does not constitute legal or tax advice. The views expressed are those of the speakers, and the comments, opinions, and analyses are rendered as of the date of this podcast and may change without notice. The information provided in this material is not intended as a complete analysis of every material fact regarding any country, region, market, industry, security, or strategy. Statements of fact are from sources considered reliable, but no representation or warranty is made as to their completeness or accuracy. What are the risks? All investments involve risks, including possible loss of principal. The value of investments can go down as well as up, and investors may not get back the full amount invested. Equity securities are subject to price fluctuation and possible loss of principal. Small and mid-cap stocks involve greater risks and volatility than large-cap stocks. Fixed income securities involve interest rate, credit, inflation, and reinvestment risks, and possible loss of principal. As interest rates rise, the value of fixed income securities falls. International investments are subject to special risks, including currency fluctuations and social, economic, and political uncertainties, which could increase volatility. Treasuries, if held to maturity, offer a fixed rate of return and fixed principal value. Their interest payments and principal are guaranteed. Active management does not ensure gains or protect against market declines. There is no assurance that any estimate, forecast, or projection will be realized. Investors cannot invest directly in an index, and unmanaged index returns do not reflect any fees, expenses, or sales charges. Past performance does not guarantee future results. Any companies and/or case studies referenced herein are used solely for illustrative purposes. Any investment may or may not be currently held by any portfolio advised by Franklin Templeton. The information provided is not a recommendation or individual investment advice for any particular security, strategy, or investment product, and is not an indication of the trading intent of any Franklin Templeton managed portfolio. Data from third-party sources may have been used in the preparation of this material, and Franklin Templeton FT has not independently verified, validated, or audited such data. FT accepts no liability whatsoever for any loss arising from use of this information, and reliance upon the comments, opinions, and analyses in the material is at the sole discretion of the user. Products, services, and information may not be available in all jurisdictions and are offered outside the U.S. by other FT affiliates and/or their distributors, as local laws and regulation permits. Please consult your own financial professional or Franklin Templeton institutional contact for further information on availability of products and services in your jurisdiction. Issued in the U.S. by Franklin Templeton, 1 Franklin Parkway, San Mateo, California, 94403-1906, 800-DIAL-BEN, 342-5236, franklintempleton.com. Investments are not FDIC insured, may lose value, and are not bank guaranteed. Issued by Franklin Templeton outside of the U.S. Please visit www.franklinresources.com to be directed to your local Franklin Templeton website. Copyright 2026, Franklin Templeton. All rights reserved. Podcast theme music by Adam Vodofsky.